Hello and welcome to the second part of this Axiory training course. My name is Joram Dreuze. I'm a financial market analyst at Axiory. And in the second part, we're going to be talking all about candlestick charts. In our first episode, the last one, we gave kind of a basic introduction to trading, what the goals are, what you can trade, but most importantly, the kind of basic philosophy behind it, which really keeps coming back regardless of how advanced you are. So that's also why I recommend going back and watching the first episode if you haven't already, because it discusses some crucial topics like variance and the law of big numbers, which will undoubtedly come back later down the line. Okay, our content for today will be: how do I read a candlestick chart? How does it differ from a line chart? What are timeframes? What is the nestling principle? Candlestick patterns, do they still work in 2026 or even later, regardless of when you're watching this? And the fractal markets hypothesis, which sounds kind of theoretical and boring, but we're going to make it very practical, and there's going to be a very clear implication. Quick disclaimer, this is just for educational purposes. I am not a qualified independent financial advisor, and if you're unsure about any investments, you should seek one. I'm going to be switching between those two slides. So a candlestick chart is really just a different representation of a line chart. In a line chart, we see just one data point per point in time. So let's say, for example, I'm looking at the GDP of a country throughout the years. For every year, I will see the final GDP number of the country. But in trading, we really want more data than just one data point per point in time. So hence why most traders will switch to something called as candlestick charts. And the reason they're called candlestick is really quite easily. If you look at how they look, they do kind of resemble a candlestick. You have this body, and then you have the part above, which you use to light it on fire. Well, not light it on fire, but light it on. And hence where the name comes from. This is by far the most common way of looking at a chart, and hence why we are discussing it in the first place. You'll immediately notice we have two different colors. We have a red one and a green one. Those colors aren't universal because there are many different ways and you can personalize this yourself, but they are the most standard ones. Green candle really just means price went up or the close was higher than the open. A red candle means as much as price went down. Now we have to specify it more clearly in a candlestick chart than just price went up or down, because we have multiple data points. So for example, let's start on the green one. We can see that the open is here. On the green candle, the open is always the lowest part of the body, so the lowest part of the thick part of the candlestick. And because the close is higher than the open, price increased and the candle is green. For example, let's say this candle represents all of trading activity on January 1st. The price at the open at 000 UTC was, let's say, $10,000. The close, so the price at 23.59 UTC, so the very last minute of trading, was at $11,000. Because the close is higher than the open, price went up and our candlestick is green. And then when we look at the bearish candlestick chart, we really just have the opposite thing happening. Our open is the highest part of the body of the candlestick and the close is the lowest part. But what you might also notice is that we have something called shadows, or more commonly referred to as wicks. They are these small thin lines that are beyond the candlestick body itself. So the candlestick body really just shows us how the open relates to the close, but it doesn't show us the absolute lowest price or the absolute highest price that was traded during the day. For example, if we take again this candlestick and we get my drawing application, we can visualize this concept. Let's say price opens here. This is midnight UTC. And it opens at 10,000. It does something like this, it goes down, and then later on the day it goes sharply up. Here we have a low of, let's say, 98,000, And here we have a low of, 11,200. Then price comes a bit down again, and here is midnight. So here is the close. If we draw all of price action into one daily candle, it would look something like this. You have the body, so the open in relation to the close. The close is higher, so the candle is green, hence my color. But we also have this. Price went all the way down to 9,800, and hence the wick, so the small thin line, will come down all the way to the very lowest price that was traded during the day, even though price did not close there. On the opposite side, price also went to here, to 10,200, so all the way up until this, and hence this price action is shown by this candlestick chart. I hope that kind of makes it clear, or at least a bit more clear, how we can actually interpret these candlesticks and how they do show us a lot more data than just a simple line chart ever could. And with that, we will go on to timeframes. I will actually already shortly touch on this, because in our example, I was talking about the daily time frame. I was saying one candlestick shows 1 day of price action, and that's really what we're talking about when we're talking about timeframes. So when you're on social media and you hear someone say, oh, I'm looking at a 15-minute time frame, I'm looking at a 1 hour time frame, what they really mean is one single candlestick, one single block represents 15 minutes or 1 hour of trading. It doesn't mean that they're just looking at 1 hour of trading, all of the blocks together, but one block is 1 hour of trading, if that makes sense. Additionally, we also have something called the nestling principle. And here it might help to think about the Matrushka dolls, if you're familiar with the small tiny dolls that fit within bigger ones. And kind of things are the same way here. So you could look at one 4-hour candle and you will know the open, high, low, and close, or an abbreviation, the OHLC, for that 4-hour period. Or additionally, what you could do is you could drop down to the 1-hour candle and you will just see the 4 1-hour candles that make up that 4-hour candle. So that way you will be able to see everything that you were able to see on the 4-hour candle, but you're just doing it on a lower time frame where there's 4 times as many candles. Or you could drop even further, for example, to the 15, to the 30 minutes, to the 3 minutes. It really doesn't matter. All that's important to know is that one candle is comprised of multiple candles on a lower time frame. Also, something I often see in trading advice, especially with strategies for beginners, is that there's a lot of importance on candle closes. And this is already a slightly more advanced tip, but nonetheless, one I thought was very important to give you quite immediately, because I do see some dangers with this kind of approach. Generally, what will happen is, for example, someone trading a simple support and resistance strategy, which we will see much more in depth later on in the course. But they might say, for example, when price breaks above $10,000, I want to buy because I think that's the highest limit, that's the resistance on price, and when it's able to break that, price will go a lot higher than 10,000. But what happens then is sometimes, and not sometimes, but majority of the times, price will just test that 10,000 and might go $100 beyond, $50 beyond. So you're constantly buying at 10,005, 10,100, 10,150, and price is immediately retracing because it's not yet through that resistance area. These areas are not one specific price. They are not specifically $10,000. They range. Sometimes resistance will be at 9,850, sometimes at 10,200. We really don't know. So instead, what they do to prevent getting caught out is they wait for a candle close. They will say, for example, oh, if the daily closes above 10,000, then I know that price has actually durably accepted above 10,000, and that's my signal to go long, because at that point, I think price will go higher much more. But there is, even though that's solid reasoning in and of itself, there are actually some problems with that. And that is that candle closes in and of itself don't really tell us that much. Price doesn't really know the time is. Time is just something that we put on the price charts to make them more readable. But a candle close doesn't in and of itself mean that there's certain characteristics that were respected, that price is truly accepting above that level. And I'd like to make that clear in a short chart example, which is actually setting up just right now in the pound dollar on the weekly time frame. So just to recap, one candle here represents 1 week. So here we can see June 29th of 2025. Here you see July 6th of 2025, and so on and so on. Someone who already knows something about candlestick patterns might notice something here, and that is this candle. It opens here and closes just a bit higher, really not that much, but you see this huge upside wick, which means that price traded quite a lot above the close, but it just wasn't able to sustain it. And when the end of the week eventually came, price closed a lot lower. In candlestick patterns, this is something called a shooting star, and it's generally seen as a bearish pattern, and rightly so, especially in this context, it actually seems quite strong. But when we think about candle closes and we drop, for example, to a different time frame, to the 3-day, we immediately start seeing the problem with the strategy. For example, someone might have had the original trade thesis that if price ventures beyond this old low, beyond this old high at 3723 and closes above it, that there would be a sustained price increase. At that point in time, they might have been looking here and seeing, oh, the candle closes here. Now all I must do is open long and price will go much, much higher. And that's exactly the point we're trying to make. The candle close really doesn't matter all that much, because what happened is price went above, tried pushing above, but just got aggressively sold off. But the candle close just happened to be before price sold off, which then in turn gave an incorrect buy signal to people who are putting a lot of attention on the daily close. And then what happens is, as you're seeing now, that price is just going back down again, and your trade will just end up in a loss. So it's not to say that candle closes are irrelevant. They definitely can help, but I would just urge some caution when you see people making all their decisions based on a candle close and realize that in and of itself, the time at which a price candle opens or closes is really kind of arbitrary. You could very much change the picture of what you're seeing, whether you flip something from the 3-day or the 2-day to the 4-day time frame. And you can kind of manipulate charts even to see what you want to see. For example, if you want to see a shooting star, and you usually look on the daily time frame, and there isn't one, but then when you drop to the 22-hour time frame, which is a really odd one and no one ever used, then somehow there is a shooting star. And that's kind of the whole problem with relying too much on these candle closes. But I think we've made that point clear, and we're gonna move on to some standard candlestick patterns. A question I envision coming is, in 2026 and beyond, can candlestick patterns still work for profitable trading? My answer would be yes, but it's really not as simple, sadly, as just remembering all of these patterns. And honestly, there's a lot more. There might be hundreds even. There's so many of them. I don't even know half of them myself. And the approach really cannot be to just memorize these, and then the second that you see them is just follow whatever they say. For example, someone seeing a shooting star, immediately just shorting regardless of what's happening. It's really not gonna work that way, sadly. We're far beyond that stuff. LLMs can easily recognize shooting stars or hammers themselves. They have analyzed this. They have scanned these patterns across all markets, across all time frames. And it seems very, very unlikely that just brute application of any of these can still work. However, that doesn't mean either that they're completely useless. For example, I will put a lot of attention myself into hammers and shooting stars, which are really just the opposite. So this one is the bullish one, this one is the bearish one. And also I put a lot of attention, and one of my best setups really revolves around what is here called harami, but I refer to as an inside day, which is when one candle resides completely within the range of the candle before it. For example, on June 21st, price might top at 11,000 and bottom at 9,000. And here you have price staying above 9,000 and below 11,000, thus creating an inside day. But what's important to know is with these candlestick patterns is that you need context. And actually, we are going to go back to our pound dollar, because that was a perfect example of when context is really good. What we are seeing there, if I just drop back to the weekly time frame, is we are seeing a very typical shooting star. Let's look at this. It's a small body with a long wick above it. Exactly the same. Price went up, but there was still a small body and a long wick beyond it. But you also kind of see the same thing happening here. And even though it all kind of worked, you have many more instances where it doesn't work. For example, here. Price seems like it will go down, and it does very shortly so, but then it reverses in a very short amount of time, and you're just left offside. And from my experience, I have to say that using these candlestick patterns just from brute application just doesn't work anymore. I've never seen it work in that style, and the only way I can see them work is with nuance. And that's exactly what this candle and this candle misses, but this one actually has a lot more of. Because what we're seeing is price pushes above here, but it also sweeps this key high, this June 29th high, that actually was the high for quite a bit of months, all the way up until 2026, early 2026. And what happens here is price pushes beyond, takes stops here, gets breakout traders who are anticipating the price will go even higher, and is then met with aggressive selling pressure. Price is coming back down, and as all of these breakout traders are getting offside, so their position is in loss, they are closing their long positions, and to close a long position you have to create the opposite order. So if I have a long position open and I want to close that position, I need to sell. That selling is pushing price down even further, which causes even more traders to become offside, which causes them to also have to close their positions, and you often get these very sharp, which here is not the case yet, but you often get very sharp moves to the downside because you get these kind of liquidation cascades, and they're not liquidation, but they are these very aggressive moves when price just ends up in a reinforcing loop, and price will see often very aggressive signals. And that's exactly the kind of context you need to be putting these candlestick patterns into good use. You need to have a good reason, a good fundamental reason why this specific candlestick pattern would work, rather than just applicating them whenever you see them. Let's get back to my actual drawings. And here, for example, in shooting stars, we talked about sweeping a high. In a hammer, you would talk about sweeping a low, but really this is kind of personal. This is just what I've observed. I've observed that shooting stars and hammers work much, much better and are actually a very profitable pattern to be observing when they sweep a prior major high or low. That's when they work really well. But for example, you might be more interested in bullish engulfings, and you find that if they locate at specific patterns or at specific times, that they work much better than others. Really, this is where I cannot tell you what to do. This is eventually, but not yet, where your own analysis and your own originality comes in. And that's how you create a strategy that is really your own and that you really understand. And in that way, with all of this context and with your own approach to things, you can very much still make candlestick patterns work. I see it happening all the time. There's plenty of profitable traders that just look at price action, just look at these chart patterns. And if you know very well what to look for, what you want to see and when you want to see it, then these are still very effective and you can get very high expectancy with these. Moving on from our charts is the fractal markets hypothesis. This sounds kind of theoretical, maybe even boring, but the implication for us is really that charts look the same regardless of which time frame they're on. So what people are basically saying is price action is price action. These candlestick patterns with the right context will work regardless if whether you're looking at gold on a weekly time frame, the S&P on a 5-minute time frame, or oil on a 1-hour time frame. Price action is price action as long as you know how to read a candlestick pattern. That's all that you need to know to be profitable. And this is a belief that is very commonly shared even in trading spheres, and people will trade every asset the same. They will be looking at Forex, they will be looking at indices, metals, whatever there is, they will be looking at just all the major markets. And then they will take a strategy that, for example, does very well in euro-dollar, and they will apply it to the S&P 500, to any other markets that they're also trading. And if this works on these other markets, great, amazing. But from my experience, the theory of this fractal markets hypothesis is quite different from reality. Different markets trade very, very different. They have different participants, with different goals. They have different depth, so they are either less or more liquid. For example, Bitcoin or the Nasdaq is very volatile. It moves a lot of points, whereas if you look at the Euro stocks, it moves a lot less. It only will move, its daily ATR is maybe 20 or 30 points compared to the Nasdaq, which will easily move 200 or 300 points in one day. So that's already something that makes such a huge difference in how candlestick patterns work. You cannot be targeting a 100 tick move on the Euro stocks when it only really tends to move 30 or 40 ticks in a whole day. So hence, price action already is not price action anymore. And you keep just getting these differentiating marks between different markets. For example, dollar yen is going to be quite logically most active, so has the most volume during the Asian and the American trading hours. But euro dollar, for example, is a lot more active during the European and the American trading hours. Euro stocks only is really active during the European hours, and in a lesser degree so during the American hours. So that's just yet another differentiating factor that will change how price is reacting on all different markets. And I want to make this even more clear with a very clear chart example. If the fractal markets hypothesis were true, it would mean that one chart, regardless of what time frame it is on, would always look the same, and no one would ever be able to look at a chart without knowing the time frame and be able to know which time frame we are actually looking at. And I want to prove the exact opposite. What we are looking at here is kind of a standard looking chart. To be honest, there is not much here that is catching my eye in terms of being able to predict what kind of time frame there is. These candles seem pretty well respected. The only thing we can notice, and which is actually giving a lot of nuance, is that here you see these gaps. You see that the close here was at this point, but then the open of the next candle is here. This is what is called an open gap. So we know that this chart has to be at least on the daily time frame, because on lower time frames, these gaps tend to be much smaller. And here, whereas on this chart, we see them happening all the time. There's a gap here, there's a gap here, there's a gap here. So we know that at least this is the daily time frame, already one step ahead of the fractal markets hypothesis. Then we go to our second chart, and here we see quite different price action. For example, we see several candles with these very, very long wicks, and they have tiny bodies, but then such long wicks, much longer than any of the candles surrounding them. This immediately kind of gives away that they're on a lower time frame, because these kind of moves really are very, very rare to see on a higher time frame. And then if we drop to our final chart, we see that price action is even different. It looks kind of blocky, I would say. It kind of looks like a barcode. You can even see the minimal tick size. You can see here that the tick is about this, so the tick being the smallest size that a chart can move, only really moves about this much. And you can see the price is very blocky. Hence, we are probably on this chart on a very, very low time frame, maybe seconds or minutes. We don't know exactly, but we can clearly see, and that is my whole point here, that just by looking at charts, even without knowing what instrument they are and what time frame they are, we can kind of get a feeling for which time frame they are on. And especially looking at this one, this lowest one, we can also kind of get a feel for how aggressive this market is. This does not at all seem like the Nasdaq. This does not seem at all like oil. This is a much, much slower, a much more liquid market, maybe like the Euro stocks, maybe like Euro dollar or bonds. And my goal with this is really not to nitpick on a theory. That's not at all what is the point of this theory. Really, the point I'm trying to make is price action is not price action. And if you have a setup that works very well in Eurodollar, I would not go as far as to assume that that setup will work just as well in other assets. I've had plenty of times where I have one setup that does amazingly well, but really just my best strategy by far on one asset. And then I try it on a different asset and it just doesn't work at all. Like, at best, it gives me after fees break-even results, and it just doesn't do at all how it does react on a different asset. And that's just exactly because to a certain degree, the fractal markets hypothesis isn't really true. Price action isn't price action. Markets move very differently. And because of that, what I'm trying to tell you is that when you see, and you will see this very often online, that people just take the exact same setup from one asset to another, from one time frame to another, it's really not as simple. There is a lot of competitive advantage to be found in specializing on one market and specializing on a couple of time frames and really feeling and getting to know very well how it kind of moves. Because all of these assets move so very differently, and if you're looking at 10 or 20 or 30 different assets on different time frames, it's going to be very difficult to get a feel for how each of them moves, and they move very differently. So there is competitive advantage in specializing on just a few and limiting your time frames also to a certain amount. For example, I will look at the daily, the 30-minute and the 3-minute. That's all I need as a day trader. And looking at just a couple of assets. For example, my focal asset is the Euro Stoxx 50. I know very well how it trades. I know what kind of tendencies it has, what it likes to do more or less than different markets. I know when it's most liquid. And I know how much size you can easily get away, what the fees are. And this is actually a huge leg up on your competition. And especially in the beginning, when you're still figuring everything out, it might be very difficult for you to learn chart patterns, for you to learn technical analysis if you're constantly switching between tons of different charts. For example, a market like Nasdaq is very prone, if we go back to our candlestick patterns, it's very prone to making hammers or shooting stars. It's just such an aggressive market that it loves making these kind of moves. Whereas something like Eurodollar will see a lot of more inside days. It will see a lot more consolidation. And then when it does move, it tends to move more consistently. But you don't get like these shooting stars where price goes up within a candle and immediately gets sold off. They do very much still happen in Eurodollar, but they're just a lot less common. And because of that, I do actually recommend for the remainder of the course that you pick maybe 1, 2, or 3 assets and you think about kind of what style you're looking for. So if you're a day trader like me, you might focus on the 30 minutes, on the 1 hour, on the 2 hour, on the 15 minutes. It doesn't really matter so much which one. All that matters is that you pick the style which you currently think aligns the best with your character and with how much time you have per day to be trading, and just what you feel most pulled to on an emotional level. And you stick to those timeframes and you stick to those assets for at least a little while until you get a basic grasp of how technical analysis works, of how you should read a candlestick chart, and about how you can start trading. And once that goes well, once you feel like, oh, okay, I feel like I've got a good basis in these 1 or 2 markets, let's say I pick gold and oil, I feel quite confident now in reading gold and oil. I start having kind of an idea of how they work when they're most active, and so on and so on. And then you can very much continue expanding to different markets. I'm not telling you to do anything really. But it makes a lot more sense that it's only when you have the basics locked down that's when you start expanding, that's when you start looking at a lot more assets. And that way you are less likely to be spinning your wheels on the more basics, instead of trying to rush the basics and then having to come back to them later on, which will feel so much more disheartening than just doing things from the slow and proper way the first time out. But that was really just a very long way of saying that when people say price action is price action, it's really not. It's not that simple. And you should also just not believe everything that anyone says online, especially in trading. You cannot agree with anyone, because if everyone agreed with you, then price would already be at that point. And that really kind of sums up what I'm trying to make clear in the fractal markets hypothesis part. And that already brings us to the end of the second part. It was a bit shorter than the first one. And I have some short homework for you, if you would like that at least. We talked about how to read a candlestick chart, why they differ, and some basic candlestick patterns. Feel free to save this image, maybe put it on your desktop somewhere that you can easily access it, and try to recognize these patterns. I don't recommend you immediately start trading them, but just look for them and see how price reacts from them. What price is doing, how often you tend to come across them, and what they actually look like in real applications. That will help you a lot more down the line, because you will just be so much more comfortable and confident in recognizing these patterns when we will actually go deeper into how to practically use them, instead of the still more relatively theoretical part which we've done so far. Also, as already said, candlestick patterns are nice and they can be profitable, but they need nuance. Otherwise, their performance is just like 50-50 win rates, 1 risk to reward, and you're unlikely to be making a lot of profit when accounting for fees and slippage. Also, no specific time frame is superior. I think that's a very important note to make as well. Also, kind of going back to not putting too much attention on where the close of a candle is. But one time frame is really not better than the other. Some people will swear by the 15-minute time frame or the 4-hour or whatever. But really, it's just about how much data you want to see. For example, if you're a day trader like me, maybe looking at the 1-minute time frame will be way too much data. You will have so many candlestick blocks that it's hard to see what's really happening. But if you have too little, if you're looking at the 4-hour time frame, for example, you might see that you're just not getting enough data to make accurate trading decisions. So it's really about finding out how long you want to hold your position, so what kind of style you fall in, whether you're a scalper, day trader, swing trader, position trader, and then choosing time frames which kind of align with this. And for example, in my case as a day trader, so I will hold my positions, most of them for, I would say, a minimum of 1 hour all the way up until 12 hours. Sometimes I do hold trades overnight, but that's more the exception than the rule. And in that application, I want to use the 1 day, which is like my higher time frame chart, which will allow me to look at what is happening on a higher time frame basis. So what the general trend is of the market. So for example, if I'm looking to buy the Euro stocks, that I'm not doing so in a larger downtrend, I will use the 30-minute as my main time frame, so which I'm looking the most at, and that's where most of my execution is happening. That's where I'm basing my decision making up. And finally, my 3-minute chart, which I really just use for managing trades that are already open, or looking at how price is reacting moving into a level and deciding based on the price action whether I want to get in or not. And that way, with just these 3 set time frames, I know very well what to look at. I am not paralyzed by all the options. I know which markets I look at. I know which time frames I look at. And if nothing is setting up in those, I know that I cannot force anything and that there's just nothing for me to happen. Whereas if you are not limiting yourself on time frames and on assets, you can just infinitely keep looking through different charts, changing and playing with the time frames until you finally found one setup that kind of resembles what your strategy is, and you will just end up tragically overtrading, which is one of the most common mistakes traders make, even more advanced one, and which will undoubtedly hurt your performance. So in that sense, on top of your homework of opening a charting platform, if you want to, there's also some other interesting homework which consists of thinking about what style you want to play. So do you feel like you're more a scalper or day trader or a swing trader? This is not a definitive decision yet, but you can go back to the first episode and think about what you feel would most align your personal situation, your characteristics. Are you someone who wants quick action, or would you rather have more time to properly analyze charts and then make decisions on a higher time frame and not constantly have to be looking at them and be able to go on about your day afterwards? And then once you've decided the style, you can use that and start thinking about what kind of time frames make sense for you. For example, if you're a scalper, you would probably start looking at the 1 minute time frame. That's a very good starting point, or the 3 minutes or the 5 minutes, but something along those lines. If you're a position trader, you might lean more somewhere to the 4 hour or the daily, or something along those lines. Whereas if you're a position trader, then you're going to be looking at least the daily, perhaps even the weekly. And in that way, the time frame you choose aligns with your general style, and you are already looking at the correct amount of data for your specific style, which will help you a lot more down the line, because you will know what time frame to look at and perhaps even what asset already, if you have some ID. Again, this is not something you're locked in. You're not locking yourself into anything. No one is forcing you to do anything. But just making these decisions and then choosing what to focus on for the beginning will help you just understand these concepts more easily later on, especially after the next episode. We will start going more into specific technical analysis techniques like Fibonacci, like support resistance, like trend following, mean reversion, and so on and so on. There will really be there's plenty of techniques out there. And we will start seeing more in practice of how to use them, what kind of nuance I think is important for using them, and how I see other traders profitably putting them into practice. And with that, we have really rounded up the conclusion as well. This is the last episode that will be publicly available. After this, all coming episodes will be on our Axiory educational portal. You don't need to pay for anything. This is still absolutely free, but you will need to sign up. I do recommend it, especially if you're serious about developing as a trader. There will be so many more parts to come. There will be parts on technical analysis, many more, as I've already shortly outlined. But there will also be a masterclass in risk management. How do I journal trades, the importance of trading psychology, and how to actually put it into practice, and so on and so on. For example, our next episode will be about market microstructure, which seems boring. It's actually going to be very practical. It's going to be about market orders, limit orders, how they differ, how they execute. And these are huge differentiators on your bottom line and what will actually make you profitable rather than the flashy techniques. So I do very much recommend that you still just go and sign up. And worst case scenario, you've just signed up with your email and that's it. There really is no cost. So I very much hope to see you back again. I hope you've also enjoyed this episode and take care.